Welcome, everybody. This is going to be one of the most exciting video presentations we've had. This is news that makes the markets move 101, actually, news that moves the market 101. Let's start with the truth. We're going to dive right in. A lot of traders see a red folder on the calendar and immediately feel one of two things, either fear or confusion. Some avoid trading completely. Um, Others ignore the news and then wonder why the market suddenly exploded, reversed, or wipes out an entire setup that they may have had that looked perfect 5 minutes earlier. That is exactly why this lesson will matter to you today. Get a notebook, get a pen, take some notes down. If you're watching live, you can always go back and watch it again and pause it. If you're watching via YouTube, definitely pause it as you go. Take some notes. Today is not about turning you into any sort of economist. It's just helping you become a calmer, wiser, better prepared trader or investor. We want you guys to understand what the major news releases are and what they actually measure and why markets actually care. I think it's a topic that we don't spend enough time really focused on. So by the end of this lesson, here's the goal. I want you to look at CPI, PPI, non-farm payrolls, GDP, central bank decisions, and oil inventories with a whole lot more confidence. Now, lots of acronyms, but not because you can predict every move, because no one can do that, but because you understand the message the market is trying to process. So our goal today is going to be very, very simple for you. You need to understand the news, not just the warning color. So before we get into the actual news releases, I want to give you a simple framework that we're going to build upon that you can use every time that you look at the economic calendar. At the top of your notes, I want you to write these three words: name it, measure it, map it. We're going to do that through this process, but this is our focus. Name it, measure it, map it. So first, name it. If you see CPI, GDP, NFP, PPI, or a PMI, don't just skip over the acronym. Know what it stands for. We get overwhelmed when the calendar looks like an alphabet soup. We are going to hopefully fix that. Second thing, we're going to measure it. We need to ask, what part of the economy is this release showing me? Is it inflationary, jobs, interest rate, growth, energy? Once we know the category, and there are five of them, the news actually becomes much easier to understand. And we're going to be moving fast. So, right quick, definitely pause if you're watching it because we're going to fly through this pretty quickly. Uh, Third thing, map it. Ask what can this actually move? Could this affect the dollar? Can it affect gold? Can it affect the bond yields? Does it impact oil? Does it impact stock indices? Does it impact a specific currency pair? This session is for all asset classes. It's no respecter. So this is the difference between us traders and investors who simply see red folders and a trader who actually understands the message behind that red folder. So our goal is definitely not to memorize every release. That would be nearly impossible to do. Our goal is actually simply to build a filter so the news actually makes more sense. So this slide, and you can take a screenshot if you like, this slide may be one of the most important slides, I think, in the entire lesson. News does not move the market just because a number appears on a screen. The market moves because that number gets compared to something else or to what traders and investors already were expecting. Think of it like this. Before the news ever comes out, the market already has a forecast. Banks, economists, institutions, investors, traders, we've already formed an expectation. And price often starts leaning around that expectation before the release ever hits. So then the actual number comes out. That is actually when the surprise happens. If the market is market expected inflation to cool by chance, the actual number comes in hotter. Traders immediately or investors immediately have to rethink the story. Maybe interest rates stay higher longer. Maybe bond yields move. Maybe the dollar strengthens. Maybe gold gets hit. Maybe stock indices react. That reaction is called the repricing. So we have an expectation to start, the forecast. Then we have the surprise in the comparison part, and then we have the repricing. So simple flows follows this. It's forecast, surprise, repricing. The forecast is what the market already expected. The surprise is that difference between what's expected and what was actual, whether it be perceived or true data. Repricing is the market adjusting to that new information. And that is why we do not just look at the actual number by itself. We actually need to do the comparison of actual versus the forecast. Then we can ask the question, what does this change? So let's start with the one biggest inflation report that traders watch, the CPI. CPI simply stands for Consumer Price Index. Think of it like a big basket of everyday expenses, rent, groceries, clothing, gas, medical care, transportation, and any other goods. I call these our budgetary items. When I build a budget for individuals, these are our budgetary items that we regularly buy. So when we say CPI is rising, we're actually saying that the cost of that consumer basket is actually rising. So you will often see CPI reported two ways. It'll say M over M or Y over Y. M over M simply means month over month. So it's comparing this month to last month. And then the year over year simply means it's comparing what this month was to the same month last year. Then we may hear a term core CPI, and core CPI is very, very similar, but it removes two pieces. It removes food and energy because those prices really can swing around a whole lot of other items. So food and energy still matter in real life to us. We all feel them. But for traders and investors, central banks, they often use the core CPI because it gives us a cleaner look at what really is happening and the underlying trend of the inflation. So here's why we should care. If CPI comes in hotter than expected, write this down. If it's hotter than expected, the market may think inflation is still too stubborn. That can lift interest rate expectations, strengthen a currency, push bond yields higher, pressure stock indices, and also affect gold. If by chance CPI comes in cooler than expected, then the market may believe that the central banks have a little bit more room to pause or cut and definitely become less aggressive. So the big takeaway for this is CPI tells us what the consumers are feeling. It's not actual, it's just the feeling part. The core CPI actually helps the market judge whether inflation pressure is truly cooling underneath the surface. Okay. Next piece is our inflation category. Our second category is inflation category. But the move is one step earlier on the economic chain. Move that. PPI, it's just a piece of the whole thing. PPI stands for Producer Price Index. While the CPI looks at what the consumer pays, the PPI actually looks at what the producers are receiving for the goods and services that they sell. So think of it this way: PPI is the upstream, CPI is the downstream. So if costs are rising for producers, which is what's happening currently, businesses may then eventually pass, and they will pass those costs on to consumers. And that is why PPI can sometimes give us an early clue about what future inflation pressure might be. Core PPI, again, core meaning it strips something out. It tries to strip out some of the more volatile categories so we as investors and traders can actually get a cleaner look at the underlying producer price trend. So the goal is not to chase every decimal point, to be honest. Goal here is to actually ask, is price pressure building, cooling, or spreading? It's going to be one of those three things. So that is core PPI. But then we go into the PCE. Again, another acronym. Most people have no idea what it means. They look at a red folder and they go, okay. But this is kind of important. It's personal consumption expenditures. This is another consumer inflation measure. but it is calculated different from CPI, and it's watched extremely closely by the Feds. Um, you will also hear traders talk about core PCE, which again removes that food and energy portion of it. Core PCE is especially important because it gives our Fed definitely a cleaner underlying view of our inflation. So here's the simple way to remember it all. CPI tells us what the consumers are paying. PPI tells us what the producers are facing. And then the PCE gives us the inflation lens that the Fed is actually watching very, very closely. And for us, all this matters because inflation feeds directly into interest rates expectations. And rate expectations can move currencies, yields, gold, indices, you name it, it moves it. And the overall market sentiment means feelings and perceptions. Now we move into the jobs bucket, and this is one of the biggest areas we need to watch. The headline report would be the NFP. If you've been in trading and investing any long time and you're doing it on your own, then you know what the NFP stands for. If not, it simply means non-farm payrolls. It measures how many jobs were added or lost in the U.S. economy, excluding the farm jobs. So when traders say it's an NFP day or an NFP Friday, this is usually the number they're talking about. And here is the important part. NFP does not stand alone. Okay. We also need to look at the unemployment rate. This tells us what percentage of the labor force is unemployed and actively looking for work. A lower unemployment rate often signals a stronger labor market. A rising unemployment rate can be a warning sign that the economy may be slowing. Take time to write that down to understand what those mean. After that, then we look at the average hourly earnings, and this is huge, especially in the US economy. This is wage growth. We hear this all the time. And wage growth matters because if wages are rising quickly, inflation can stay extremely sticky. Businesses may have pay more for their labor. They're going to have to. And those costs can and normally will eventually show up in prices. They're handed down to the consumer. So when we as consumers ask for a higher minimum wage across the board, what we're asking for is not more money in our pocket. We're asking, and it does that temporarily. But at the end of the day, the consumer price goes up to match that raise. And that's where we are fighting. So quality jobs is a key piece and not being stuck at a part-time job scenario in a career. We need career that actually pays the bills. I'm not saying you can't have more than one job. So go back to NFP. NFP tells us job growth. Unemployment tells us labor market strength or weakness. And that our average earnings tells us what the wage pressure is. So for us, the most powerful setup is often when we see the jobs and wages tell the same story. Strong jobs plus hot wages can make the market think that the central banks may need to stay tighter. A softer jobs report, cooling off wages can make the market think policy may eventually need to ease. So that is why on NFP day, we are not, or we should not be just asking how many jobs were added. We really should be asking what does the full labor picture say about growth, inflation, and interest for the future. Now, the labor story does not begin and end with the NFP. We've got some supporting documents with that as well. The NFP is the big monthly headline, which we all watch several labor reports in between because there are several ones that can give us an early clue about whether the job market is staying strong or starting to crack. So the first one we want to be paying attention to is the jobless claims. And this usually comes out weekly, shows how many people filed for unemployment benefits. And the claims matter because they are timely. It means they're immediate. If claims start rising week after week, that tells us we may begin to wonder if layoffs are increasing and if the labor market is actually weakening. So keep that in mind with jobless claims. Then we have the JOLTS. Nobody ever understands what this stands for. We definitely know what it impacts. If you don't, here we go. JOLTS stands for Job Openings and Labor Turnover Survey. The part we traders, investors usually focus on is actually the job openings. So if job openings are high, it can suggest that the employers are still looking for workers and the labor market is tight. If the openings fall sharply, that may be suggesting demand for workers is cooling. And then after JOLTS, we have the ADP, which is a private payroll estimate released before the official NFP. ADP can be very, very helpful, provides context, but we don't want to treat it like a crystal ball. It can point in the right direction, but it does not always match the official payroll numbers. So think of claims, JOLTS, and ADP as the supporting clues to the overall NFP. And they may not always create the biggest move by themselves, but they help us build that labor market story before the main NFP actually a report actually arrives. So central bank days are huge because those central bank people, individuals, institutions sit right at the center of market pricing. A central bank, like the Fed for the US, the ECB is for the Euro area. BOE is for the UK, it's Bank of England, Bank of Canada, BOC for Canada, BOJ for Japan. And then the strange one, the RBA, that's for Australia. Those are the entities that set the policy interest rates. Those rates influence everything: borrowing costs, economic growth, inflation pressure. Again, we're talking about inflation a lot, bond yields, currencies, stocks, and gold. But here's the key with this. The headline rate is only part of that story. Sometimes the central bank raises rates, cuts rates, or holds rates exactly as they are expected to do. And then the news comes out and the market still moves extremely hard, even though everything was already set in stone. Why is it moving? Because we as traders and investors and institutions and other people are listening to the actual policy statement. The statement tells us how policymakers see inflation, see growth, see jobs, and see future risks. These are perceptions in many cases, based on data, but it's still perceptions. It also gives us a clue about what they may do next. May do next. I love the statements when they come out and you read them. You'll often hear two words during those central bank statements: hawkish and dovish. Hawkish usually means the central banks sound more worried about inflation and may keep rates higher for longer. We're in a hawkish system right now. Dovish usually means the central bank sounds more concerned about slowing growth or more comfortable with inflation cooling, which can open that door for easier policy later on. So when we, as traders and investors, see rate statement or monetary policy statement on our calendar, we should understand that this is not just a number, it's an actual official signal about where monetary policy may go next. And that is why the rate matters. But the message matters too. So this is where we many times get caught off guard. We focus on the rate decision, but then the bigger move comes during the press conference, the minutes, or even a speech later in the week. Let's talk about the press conference. This is where central bank leaders explain the decision and answers questions. And these can be fun to watch. This matters because everyone's listening for a tone. They're looking for a tone. Does the leader sound worried about inflation? Is there more confident that inflation is cooling? Are they concerned about growth? Open to future rate cuts, possibly? That tone alone can move the market. And it's all perception because this is a press conference. There are some notes and data behind it, but words matter. And so what people take from it is perception. And then we dive into our minutes. Okay. These come out after and give more detail about what the committee actually discussed. So traders, investors, banks, institutions, we use these minutes to understand the press conference a little bit better and whether policymakers were mostly united or were they divided and what risk are they focused on. That's and again, the press conference, one bad word slipped out, not an unintended word, I would say, comes out, the minutes will help you understand it. And then here's where we get into our speeches. And this could be even presidential in many ways. So then we have our speeches. Central bank speakers can actually move the markets even when they didn't want to, intended to. These are fun. So even when there's no major release of any sort of news data, one single comment about inflation or growth or future rate policy can shift expectations extremely quickly. So when you see ECB press conference or FOMC minutes or BOE governor speaks or any other another central bank speech or on the calendar, don't treat it like a filler. These actually help the market. These events are going to help the market interpret where policy may be headed next. Again, we can't make prediction, but we can look at the clues. We're investigators. The decision is the headline. Remember, the decision is the headline. The explanation, I should say, the explanation can be the actual market mover. Now, we're going to step into the growth bucket now, the GDP. This is what we all talk about. Most people know what a GDP is. So I'm going to move quickly through this, not spend a lot of time, but GDP simply stands for gross domestic product. It is one of the broadest measurements of our economy. In simple terms, GDP is asking how much is this economy producing and spending overall. How much are we producing and how much are we spending overall? The GDP is made up of several major pieces, and that could be consumer spending, um, um, government spending, business investment, and net exports. Consumer spending is the easy one. It shows what households like you and I are buying. Business investments show whether companies are overall are expanding, building, or are they pulling back. Government spending, my goodness. Government spending reflects public sector activity. And net exports is probably the least understood, but this is simply comparing what a country sells to the world versus what it's buying from the world. So GDP is not just one little report, it's a broad report card. I call it a semester report card on the whole economy. It happens more regularly than a semester would, but it's a bigger, broader report card, significant. Traders and investors, we definitely care about the GDP because it answers some big questions. Is this economy expanding? Is it slowing, or is it possibly headed toward a recession even? So those are key questions with GDP. And again, GDP tells the big picture story, but we also need faster clues between those GDP reports, and we got them. That is where PMIs come into play, retail sales, consumer sentiment, and housing data play a part. PMI simply stands for Purchasing Managers Index. Okay. It is a survey of business conditions, usually in manufacturing or in servicing. A PMI reading above 50 often will signal expansion. On the opposite, if it's signal and reading below 50, often will signal contraction. Write that down so you know what you're looking for. Now, it's a survey, some opinion, some fact, but still it's relevant to the overall understanding that 50 greater than is expansion most times, and lower often signals contractions. So the reason we watch PMIs closely is because it can actually give us an early read on the economic momentum, getting us a jump on things. Businesses often feel changes before they actually fully show up in those slower reports like the GDP. So moving on to retail sales, this is different. Retail sales gives us a look at what consumer spending is. Since consumer spending is a major part of any economy, we want to know whether households are still spending or starting to pull back. That gives us some clues. Then we have the consumer confidence and consumer sentiment. This report is used oftentimes politically to either prop up the current administration or take down the current administration. These are survey-based reports that show how people feel about their finances and economy. I always put that feel word out because perception does not mean truth and fact. Perception may be the reality of that person, but perception may not be truth. So I'm always a little leery on some of these surveys because it is a feeling. It's not that I ignore them. They do not guarantee a future spending, but they do give clues about whether consumers, who are the driver of any economy, are becoming more confident or they're becoming cautious. So that's what I've taken on the consumer confident, consumer sentiment index stuff. Housing data. This also matters because housing is very sensitive to interest rates. So we are kind of getting an economic lesson here. So when rates are high, mortgages become more expensive, obviously, and housing activity can slow if it's too much for the consumer to buy. If housing weakens sharply, it may be a sign that tighter policy is starting to bite. So, just the simple takeaway for this bucket is this: these reports help us track momentum before the full GDP picture actually is complete. So when we're looking at PMI, retail sales, sentiment, and housing, it's giving us a precursor to what might be coming with the complete GDP picture. So again, the GDP is the big report card at the end of the semester. That's how I look at it. And the PMI, retail sales, sentiment, housing are kind of like the 6 week checks. They're a faster pulse check. The final bucket is the energy and commodities bucket. And this area can affect everyone more than you would ever realize, even if you never place a trade on crude oil. So let's start with the crude oil inventories. This is a weekly report. It helps traders understand the oil supply and demand. So, in very, very simple terms, it's just asking how much oil is sitting in storage right now. You will often hear the words, two words in this report, build and draw. Build simply means inventories are increased. There's more oil sitting in storage than there was previously. If the build is larger than expected, okay, build is larger than expected, then we can expect oil prices can get becoming under pressure because supply looks heavier. Okay, that means there's a potential oil decrease in price. We build supply. On the opposite side, draw just simply means the inventories are decreasing. That means there's less oil sitting in storage than there was before. If the draw is larger than expected, then expect the oil prices can rise because demand may be stronger or supply may be less. So higher demand, less supply means price increase. Lower supply usually means that the same thing. So be aware of those supply and demand pressures. 1 month of news just gives us a sample, but the rhythm repeats all year long. The exact names, dates, countries may change, but the big categories stay very, very consistent. The categories, again, write them down: inflation, jobs, central banks, growth, and energy. Every month, we will see reoccurring reports like CPI, PPI, PMIs, retail sales, weekly jobless claims, labor data, and comments probably from the central bank speakers. Quarterly, though, we tend to see the bigger picture reports like the GDP, maybe some inflation updates, definitely central bank projections, meeting minutes, and then definitely major policy decisions. That's why June was such an important month. And then we have those anytime risks. If we look at our calendar on that, they come anytime. These do not always follow the clean schedule. For instance, OPEC headlines, geopolitical shocks, war notices, surprise central bank comments, elections, emergencies, any sort of major crisis, weather crisis. They can hit the market without much of a warning at all. And this is why we do not want you guys memorizing a month's calendar. We actually want you to learning the rhythm of them. Because if you understand the categories, you can look at almost any month and say, I know what kind of event this is. And then I know what is trying to measure, and then I know what markets may care about the most. So the event names change, but the market categories repeat. As we get ready to close off our session, last few moments, here's the practical part for us as a good trader investor. A good trader does not simply say, hey, there's a red news today. A good trader, good investor actually reads the calendar with a purpose. So before the release, know the time, the currency involved, and the market expectation. If it is a CPI print, What is the forecast? What was the previous number? What is the market likely hoping to see? At the moment of the release, compare the actual, the forecast, and the previous. Then watch how the market interprets it. You can see that on the charts. Remember, the first move is not always the final move. Spreads can get real wide, by the way. Liquidity, that is the ability to be able to buy and sell easily in and out of an asset. Liquidity can thin out, which means that even if you have a stop, you may not get out at the price you wanted to. It could be worse for you. Okay. So understand liquidity. And that is why the discipline part and understanding matters. We don't want to chase the first candle just because it is fast moving, especially if we're a day trader. After the release, ask the deeper question. Did this change the broader macro story? Or did this release make a rate cut more likely, less likely, or leave the story basically unchanged? We want our traders to be able to step back, interpret the message, and then decide whether to trade, wait, or stand aside. And just so you know, the more prepared you are, the better and more calm you become as a trader and investor. And again, we talk about this all the time. We talk about being an airline pilot and having a checklist. Routines are key. Jumping on a computer, turning on your platform, and just start trading is not a routine. Okay. This slide is all about routine. One of the best things that we can give you guys is a process that you can repeat every week, every day before high impact news. First, you want to ask, what exactly is the release? Which category does it belong to of the five? Is it inflation, jobs, central banks, growth, or energy? If I cannot explain what the release is, I should not pretend I understand the risk around it. So be able to explain it. Second, expect. What is the market forecasting? What was the previous number? What kind of result would be considered hotter, cooler, stronger, weaker, hawkish, dovish? And this helps us think in scenarios instead of with the emotion part. And that's hard. Third, our plan. Which pairs or assets are likely to react? Will I trade before the release? Am I going to have a rule that says 15 minutes, 30 minutes, 1 hour before I won't trade, before or after? Or wait until after the release is completely done, or stand aside completely? Again, there's no shame in standing aside. Sometimes when I see the busy days, I just walk away because it's not worth it. Sometimes the smartest trade is just being patient. So if we build this checklist habit, we will stop being surprised by the calendar. Instead, you're going to feel definitely more prepared, and that is really where your real edge comes from. It comes from having discipline always beating excitement. Preparation always beats guessing. As we move up and get ready to wrap up, here's the heart of this lesson. And I hope you got some value. I hope you took some notes. I hope you took it serious. I hope you go back and pause and look screenshots. But most major red folder events are not random. They usually fit into one of the five buckets: inflation, jobs, central banks, growth, and energy or commodities. They're one and the same. And when you start to sort the news that way, the calendar definitely becomes less intimidating. Second thing, remember markets react to surprises versus expectations. The actual number matters, but the relationship between that actual and the forecast is often what creates the first major reaction. And then third, don't just memorize the acronyms. Build your process. And remember, we started with name it, measure it, map it. That is your process. Name it, measure it, map it. Know what the release stands for. Know what it measures. Know what markets it can move. And then decide whether you should trade, wait, or stand aside. And it's not easy to memorize this stuff. I'm continually getting mixed up. So I have to go back and refresh myself. And I've been doing this for years. And I can't always on the spot tell you what a certain acronym stands for. I usually knows what category it is in, but so it is a process, and that is disciplined trading. That is disciplined investing. That is proper stewardship, and it's wise stewardship. And that is how we become calmer, better prepared market participants. We were not created to live in a world of chaos and hypersensitivity. God did not create us for that. We need to be calm, knowing that all things are in some order and praying that we all recognize the order. So the goal is not fearing the calendar. The goal is to truly understand it, prepare ourselves to not fear it. And that's the biggest thing. I hope you took away some strong, valuable lessons in today's session. I try to do my best to get it within that 30 to 40-minute window. I hope you pulled some nuggets. If you do me a favor, if you're not live and you're watching by YouTube, go to the comments and tell me one thing, or tell TraideMasters one thing that you learned from this particular video. That helps us know where you're at as well. We don't talk about news often, probably not often enough. So I hope this is a good place to leave off. And again, if you have any questions, put them in the comments and we'll do our best to answer them. Again, thank you for being here. Thank you for watching, and thank you for being a part of TraideMasters. God bless.